The financial crisis is no longer a distant threat. It's here, on our doorstep. Robert Kiyosaki, the man who predicted this economic storm, is warning us. He announces an imminent disaster and advises withdrawing our money from banks to protect our financial future. With constantly rising interest rates, banks facing unprecedented difficulties, and signs of hyperinflation on the horizon, we are living in a time marked by unprecedented economic uncertainty. What does all this mean for you, for me, for all of us? What are our options in a world where the money we have worked hard to earn and deposited in the bank could soon lose its value? Stay with me, because in this video, we will dissect Kiyosaki's predictions, analyze the impacts on our economy, and most importantly, reveal investment strategies that could help us navigate through this looming financial storm. Robert Kiyosaki, a name many of us associate with smart investing and entrepreneurial success, has recently issued a severe warning. Not long ago, in a tweet that went around the world, he warned against runaway inflation and an imminent financial crisis fueled by the monetary policy of the Federal Reserve. Openly accusing politicians of hiding the real cost of bailing out banks, he highlights the relentless printing of money by central banks as a recipe for hyperinflation. These predictions are not empty words. They are already finding echoes in reality. We have seen once solid financial institutions like Silicon Valley Bank and Signature Bank shake and fall in the face of the financial crisis. Inflation, despite a recent downward trend, remains a worrying specter haunting our economy. As the local banking sector is rocked by unprecedented difficulties and pressure mounts for regulators to intervene, a question arises. Should we accept a certain level of inflation as the lesser evil, or run the risk of even greater financial instability? The increase in interest rates might seem beneficial for savers, but what about the impact on mortgages, bonds, stocks, and credit card debt? What if the solution was to invest our money in tangible assets that increase in value over time rather than letting it depreciate in the bank? Stay with us as we delve deeper into these questions and explore investment strategies that could help you prepare and protect yourself in this imminent financial storm. In a period of financial tension like the one we are going through, where each day brings new uncertainties, financial security is more important than ever. Robert Kiyosaki, an experienced investor and respected author, has some advice for those looking to navigate these turbulent waters. And if you think his advice is to leave your money in a bank, think again. Instead, Kiyosaki warns against the danger of leaving money in banks during times of economic uncertainty. With the current policies of the Fed and predicted rampant inflation, the value of your money could well decrease faster than you think. In fact, Kiyosaki goes as far as to suggest that it might be better to take your money out of the bank. This is a bold statement that gives us something to think about, but it raises a question. If we don't leave our money in the bank, what do we do with it? This is where Kiyosaki's advice becomes really interesting and potentially life-saving. Instead of letting your money lose its value in the bank, why not invest it in assets that are likely to increase in value over time, assets that can withstand economic fluctuations? This is where gold and silver come into play. Despite the difficult times we're going through, there are always opportunities for those who know where to look. Robert Kiyosaki reminds us of a golden lesson, literally, the importance of investing in gold and silver. These precious metals have proven their value by standing the test of time and inflation. Unlike paper currency, whose value can be eroded by inflation, gold and silver have intrinsic value. Their supply is limited. We cannot print gold or silver like we do for currency. In times of uncertainty, they tend to maintain their value or even increase. Are we looking for concrete examples? Let's take a look at the recession of 2008. When banks were falling and panic was gripping the market, there were investors who followed Kiyosaki's advice. They invested in treasury bonds and gold, and these wise investments paid off. In hindsight, they saw their assets not only preserved, but also significantly increased in value. Naturally, one might wonder how to start investing in gold and silver. There are many ways to invest: buying gold or silver coins, bullion, or investing in mutual funds or ETFs that track the price of these precious metals. The key is to do your research, understand how the market works, and make informed decisions. It's important to highlight that, like any investment, gold and silver come with their own risks. Their value can fluctuate based on various factors, including market demand, global political and economic stability, and even mining production. That's why it's essential to diversify your portfolio and not put all your eggs in one basket. It's crucial not to succumb to panic, but to think strategically and make prudent and balanced investment decisions. However, in an uncertain world, with an imminent financial crisis and inflation levels that are alarming, gold and silver can offer some assurance. They may not make you rich overnight, but they can help protect your wealth in the long term. That's financial prudence, and in these turbulent times, prudence might just be the best investment you can make. Stepping slightly away from Kiyosaki's advice, it's imperative to keep in mind that investing in gold and silver is only part of the overall strategy for dealing with a financial crisis. There are other key aspects that deserve our attention. Diversifying your investment portfolio, for example, is one of the most effective ways to minimize financial risks. By spreading your money across different types of investments, you reduce your dependence on a single asset or market. This could mean diversifying across different asset classes, such as real estate, stocks, bonds, and of course gold and silver. Or it could mean diversifying within the same asset class, for example, by owning stocks from different companies in different sectors. Alongside diversifying your portfolio, it is also important to establish an emergency fund. This fund, typically equivalent to 3 to 6 months of living expenses, can provide you with a safety net in case of a financial crisis. An emergency fund allows you to cover unexpected expenses without having to sell your investments at a potentially unfavorable time. Additionally, paying off your debt can also be a wise strategy during a financial crisis. Interest rates on debt can quickly accumulate, especially when interest rates rise, as is often the case during a financial crisis. By paying off your debt, you can reduce your exposure to this risk. Finally, and most importantly, financial education is a key tool for navigating any financial crisis. This means understanding how different types of investments work, how to read and interpret financial statements, and how to evaluate potential risks and rewards. The more informed you are, the better equipped you will be to make wise financial decisions. And this is where we'd like to turn the conversation over to you. What do you think of these strategies? Do you have any other advice for preparing for a financial crisis? We'd love to hear your thoughts and experiences in the comments below. Also, don't forget to subscribe to our channel and activate notifications so you don't miss our upcoming videos. Thanks for watching. Don't forget to subscribe for more.